Army, earned a master's degree in public policy from Harvard's John F. Kennedy School of Government, and a law degree from Harvard Law School. One of the highest honors and greatest privileges of his life was commanding his fellow soldiers. He served in the 82nd Airborne Division and eventually joined the faculty at West Point, where he served until August of 1979, resigning from active duty as a captain, but continued to serve in the reserves, where he left with the rank of major in 1991. After graduating law school, the senator was an attorney in private practice back in Providence. He served 3 terms in the Rhode Island State Senate and 3 terms in the United States House. In 1996, the people of Rhode Island elected him to succeed Claiborne Pell as the state's 46th United States Senator. He has worked every day since to help make the federal government more efficient, effective, and responsive to the people of Rhode Island. He has a proven record of working on a bipartisan basis to help solve problems and achieve results. Many of us in this room also had the opportunity to go to his Business Leaders Day in Washington recently, and we saw firsthand the respect of his peers from both sides of the aisle. He is the senior member of the powerful Appropriations Committee, which controls the funding of the United States government, and has worked tirelessly to direct federal funding to the Ocean State. He is one of just 8 United States senators in the history of the United States Senate to graduate from West Point, and has used that knowledge as the ranking member of the Armed Services Committee, where he's played a pivotal role in safeguarding our nation and growing Rhode Island's defense sector. And as senior member of the Banking, Housing, and Urban Affairs Committee, he has authored several key pieces of legislation, including historic Wall Street reforms, and has been a nationally recognized leader for his dedication to protecting U.S. consumers. Today, Senator Reed continues to use the lessons he learned growing up in Cranston, which were deepened in the Army and have been tested in the halls of Congress, and stands up and speaks out for hardworking families who are the heart and soul of this country. He is dedicated to the nation's security and ongoing prosperity. Senator, we are grateful for your support for this event, for the work of the Greater Providence Chamber of Commerce, your advocacy for our members and their businesses, and for being a champion for our state, and putting into practice each and every day the values that you learned at that kitchen table on Pontiac Ave in Cranston. Senator Jack Reed.
Well, thank you very much, Rick, for that extraordinarily kind introduction. I also want to thank Lori White for her great leadership and all the members of the Greater Providence Chamber of Commerce. To all my colleagues in government, thank you for joining us here today. I want to particularly shout out to Susan Collins, the president of the Federal Reserve Bank of Boston, an extraordinary public servant, and President Mark Palange of the University of Rhode Island. He has really taken a great university and made it even greater. Thank you, Mark. Today, I have a distinct honor. That is to welcome Jerome Powell, the chair of the Federal Reserve, back to Rhode Island. Along with many of my colleagues on both sides of the aisle, I have long appreciated Chairman Powell's decency and steady leadership and commitment to the values that distinguish America from every other country in the world. He has the distinction of having been appointed by a Republican president and reappointed by a Democratic president. He has shown the courage to make tough decisions in an exceptionally challenging economic and political environment. And he has made these decisions based on the data and the facts and good analysis. And that is something increasingly rare these days. It feels like a much different world today than the last time Chair Powell addressed us in 2019. The COVID-19 pandemic brought substantial economic upheaval, including unemployment rates we had not seen for decades. That crisis was followed by a serious bout of inflation. And in fact, every economist, left and right, were predicting not about the coming recession, but how severe it would be. Because of Jerome Powell, there was no recession. Chair Powell deserves credit for navigating those choppy waters. Nevertheless, average Americans are still facing significant economic challenges due to the chaotic policy agenda of the current administration. Tariffs, health care cuts, a massive debt increase, and interventions in the operations of major corporations and universities have all proved disruptive and costly. Real wages for most American workers remain stagnant. We still have not fully tamed inflation. Roughly 36 million Americans are experiencing poverty, and housing is too expensive and in too short a supply everywhere, but particularly here. The policy chaos is extended into a direct assault on the Fed's independence and personal attacks by the President against members of the Fed. But Chair Powell has met these challenges with equanimity and professionalism. He understands that a strong and independent central bank can contribute to sound economic policy in this nation. He understands the impact that monetary policy has on communities and families and businesses. He has somehow managed to stay laser focused on achieving the Fed's dual mandate to achieve maximum employment and stable prices. Chair Powell, thank you for doing your job with honesty, integrity, and humility. I speak for all of us here. There are few examples of patriotic, decent dedication to the nation than Jerome Powell. And thank you for returning to the Providence Chamber during your final few months as Fed Chair. You are more than welcome. Ladies and gentlemen, would you please join me in welcoming Chair of the Federal Reserve, Jay Powell.
Thank you for your warm reception, and thank you, Senator Reid, for your very kind introduction. It is a pleasure to be back in Rhode Island. The last time I had the opportunity to speak to the Greater Providence Chamber of Commerce, as Lori mentioned, was in the fall of 2019, actually November 25th, 2019, and I said then, quoting, "If the outlook changes materially, policy will change as well." Well, little did any of us know, just a couple of months later, the COVID-19 pandemic arrived. Both the economy and our policy evolved dramatically in ways that no one could have predicted. Along with actions by Congress, the administration, and the private sector, the Fed's aggressive response helped stave off historically severe downside risks to the economy. The COVID pandemic came on the heels of the painfully slow, decade-long recovery from the global financial crisis. And these two back-to-back world historical crises have left behind scars that will be with us for a long time. In democracies around the world, public trust in economic and political institutions has been challenged. Those of us who are in public service at this time need to focus tightly on carrying out our critical missions to the best of our ability in the midst of stormy seas and powerful crosswinds. Throughout this turbulent period, central banks like the Fed have had to develop innovative new policies that were designed to deliver on our statutory goals during times of crisis, rather than for everyday use. Despite these two unique, extremely large shocks, the U.S. economy has performed as well or better than other large advanced economies around the world. And as always, it's essential that we continue to look back and learn the right lessons from these difficult years. And that process has been ongoing now for more than a decade. So, turning to the present day, the U.S. economy is showing resilience in the midst of substantial changes in trade and immigration policies, as well as in fiscal, regulatory, and geopolitical arenas. These policies are still emerging, and their longer-term implications will take some time to be seen. Recent data show that the pace of economic growth has moderated. The unemployment rate is low but has edged up. job gains have slowed and the downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In recent months, it has become clear that the balance of risks has shifted, prompting us to move our policy stance closer to neutral at our FOMC meeting last week. GDP rose at a pace of about 1.5% in the first half of this year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. Activity in the housing sector remains weak, but business investment in equipment and intangibles has picked up from last year's pace, largely reflecting the AI build-out. As noted in the September Beige Book, which I bet you wonder what it is, the September Beige Book, that's a report that gathers qualitative information from across the Federal Reserve System. We'll talk about later. Businesses continue to say that uncertainty is weighing on their outlook. Measures of consumer and business sentiment declined sharply in the spring. They have since moved up, but remain low relative to the start of the year. In the labor market, there has been a marked slowdown in both the supply of and the demand for workers, an unusual and challenging development. In this less dynamic and somewhat softer labor market, the downside risks to employment have risen. The unemployment rate edged up to 4.3% in August, but has remained relatively stable at a low level over the past year. Payroll job gains slowed sharply over summer months as employers added an average of just 29,000 per month over the past 3 months. The recent pace of job creation appears to be running below what we call the break-even rate, that is the rate needed to hold the unemployment rate constant. But a number of other labor market indicators remain broadly stable. For example, the ratio of job openings to unemployment remains near 1, and multiple measures of job openings have been moving roughly sideways, not down, as have initial claims for unemployment insurance. Inflation, meanwhile, has eased significantly from its highs of 2022, but remains somewhat elevated relative to our 2% longer-run goal. The latest available data indicate that total PCE prices rose, that's personal consumption expenditure prices, that's the inflation measure that we follow most closely, rose 2.7% over the 12 months ending in August, up from 2.3% in August 2024. Excluding the volatile food and energy categories, core PCE prices rose 2.9% last month, also higher than a year ago. Goods prices, after falling last year, are driving the pickup inflation. Incoming data and surveys suggest that those price increases largely reflect higher tariffs rather than broader price pressures. Disinflation for services continues, including for housing services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs. Beyond the next year or so, however, most measures of longer-term inflation expectations remain consistent with our 2% inflation goal. The overall economic effects of the significant changes in trade, immigration, fiscal, and regulatory policy remain to be seen. A reasonable base case is that the tariff-related effects on inflation will be relatively short-lived, a one-time shift in the price level. Now, a one-time increase does not mean all at once. Tariff increases will likely take some time to work their way through supply chains. As a result, this one-time increase in the price level will likely be spread over several quarters and show up as somewhat higher inflation during that period. But uncertainty around the path of inflation remains high. We will carefully assess and manage the risk of higher and more persistent inflation. We'll make sure that this one-time increase in prices does not become an ongoing inflation problem. Turning to monetary policy, near-term risks to inflation are tilted to the upside, and risks to employment are tilted to the downside, a challenging situation. Two-sided risks mean that there is no risk-free path. If we ease too aggressively, we could leave the inflation job unfinished and need to reverse course later to fully restore 2% inflation. If we maintain restrictive policy too long, the labor market could soften unnecessarily. When our goals are in tension like this, our framework has long called for us to balance both sides of our dual mandate. The increased downside risks to employment have shifted the balance of risks to achieving our goals. We therefore judged it appropriate at our last meeting to take another step toward a more neutral policy stance, lowering the target range for the federal funds rate by 25 basis points to 4 to 4.25%. This policy stance, which I personally see as still modestly restrictive, leaves us well positioned to respond to potential economic developments. Our policy is not on a preset course. We will continue to determine the appropriate stance based on the incoming data, the evolving outlook, and the balance of risks. We remain committed to supporting maximum employment and bringing inflation sustainably to our 2% goal. Our success in delivering on these goals matters to all Americans, and we understand that our actions affect communities, families, and businesses across the country. So thank you again for having me here, and I very much look forward to our discussion. Thanks.
Thank you very much. Good afternoon once again, Mr. Chair. Thank you for those opening remarks and reminding us just how tremendously the world has changed and evolved since you were last here in 2019. President of the Federal Reserve Bank of Boston, Susan Collins, is also here with us today. And President Collins, we have had the opportunity many times to discuss with you the conditions in this Fed region, of which Rhode Island is part of the Boston region. So, Mr. Chairman, I would ask you to think about your comments reflecting on the importance, what you have said, the importance of deeply understanding local labor markets. And I'm wondering if in your deliberations leading up to the most recent FOMC meeting, whether there was anything particularly distinctive in what you saw coming out of the Boston Beige Book.
So let me say a word about the Beige Book. So there are 12 reserve banks, as you know, around the country, and each of them has deep ties into not just the business community, but medical community, educational community, nonprofits. And each FOMC cycle, which is sort of 8 of those a year, they do a deep dive and they collect lots and lots of information about the economy. And so, and that information gets collated and put into what we call the Beige Book because it's beige. And we're not that original. And so we get that a couple weeks before each FOMC meeting. And I have to say, I don't know of any source of sort of qualitative information about the economy that even approaches this. It's just a lot of conversations with a lot of people, and I personally find it very useful. Sometimes you look at that book and you see significant regional differences, and this is not one of those times. So, for example, the Boston Fed piece in the last Beige Book talked about lots of spending on AI. Well, guess what? That was pretty common across 8 or 9 of the districts. So I would say nothing really jumped out from the Boston piece. What you saw was all around the country, you saw pretty modest growth, wage and price inflation at modest to moderate levels, the economy growing but not fast, and uncertainty, significant uncertainty about federal public policy is kind of weighing on investments and decisions about investment and hiring, except in the area of the AI build-out, which is just going really strong pretty much in many parts of the country.
So nothing distinctive from the Boston region that would inform your future decision-making looking at the setting of monetary policy?
What I saw from Boston was quite similar and overlapping with a number of other districts. Again, sometimes that's the case where things are pretty much of a piece. Sometimes different regions, particularly if there's a commodity price thing, you would see maybe things in the commodity-oriented regions doing differently from other regions of the country. Right now, it's much more the same around the country, I would say.
So let's talk about and build on what you described a few moments ago about the dual mandate of the Fed. And if you could talk about these conditions that wax and wane over time, what signals will you be looking for in the run-up to the next FOMC meeting, which is in roughly 30 days?
We have two goals, as you mentioned, maximum employment and price stability, and they're equal goals under the law. So almost all the time, they work together. They complement one another. So for example, when the economy is weak, the unemployment rate might be high and the inflation rate would be low, and that it calls for stimulus from us. And when the economy is really strong and the labor market is tight, that's when inflation will be moving up, and so policy might be a little bit tighter. That's almost always the case. Right now is the quite unusual case where risks to, as I mentioned in my remarks, risks to employment are to the downside and to inflation to the upside. Now, we only have one tool, which is monetary policy, really interest rates, and really it's calling for different answers. So for a long time, we have a document called the Statement on Longer Run Goals and Monetary Policy Strategy. We call it the consensus statement to save time. That says, for a long time, it's said that when the two goals are in tension, we'll look at how far each one is from its goal and the time that it's expected to take to get back to that goal. And so we balance the two goals. So what we've done all year, this year, is we've had our policy rate has been tight because inflation has been above our target, but the labor market was very solid. Now, over the last really 4 months, really over the summer, the labor market has softened. Payroll jobs have dropped a lot, so we can't really say that anymore. And I think what that told us is that stance of really having a tight focus on inflation really needs to moderate toward a more balanced approach. And so that's why we took the action we took at our last meeting. And as we go to our next meeting, to your question, we'll be asking ourselves, we'll be looking at the data very carefully, labor market data, growth data, inflation data, all of the vast quantities of data that we get, and asking ourselves, is our policy in the right place? And if not, we move it there.
Some may wonder about the frothiness of the markets, the markets reaching record heights and also record valuations. How does the Fed think about that in the equation?
Financial markets? So obviously we monitor financial markets very carefully. Our policy works through financial conditions. So that's credit spreads and interest rate levels and equity prices in the aggregate that can affect spending, for example. We look at all of that, but really our focus is on our two goals, and that is maximum employment and price stability. And when we see one of them weakening, we're going to respond appropriately with our tools. And in this case, that meant reducing the federal funds rate by 25 basis points. And we'll see what the future brings, but that's what we do. We look carefully at financial conditions, more from a perspective, though, of financial stability. So we see that the banks are well capitalized. Actually, in the aggregate, households are in good shape financially. I know people at the bottom end of the income spectrum are under pressure. No question about that, but it's not a time of elevated financial stability risks.
Mm-hmm. So the federal funds rate really governs consumer credit, but not so as it pertains to mortgage rates, correct?
That's right.
And let's talk about how the average consumer is going to see any difference in the intervening months relative to an easing of interest rates and the ability and maybe even more confidence to spend.
So we don't set mortgage rates, but when we change the federal funds rate, it will affect the mortgage rates and also all other consumer borrowing rates. Really, all interest rates that are on a floating basis will move a little bit or even a lot if they're short term, based on our moves. So the people will feel that over time. Also, it's not just these days. The market is pricing in the next 6 months what's going to happen to rates. So this is something that wasn't really the case 50 years ago. Now markets listen to us and follow, and they make an estimation of where they think rates are going. And so they'll price things in. And so longer term rates will move because of what the market participants expect us to do. So you'll begin to see, and you're already seeing changes in rates. Long before we make the decision, it can often be already priced in.
Is it fair to say that the Fed and the markets really have a higher tolerance for risk today, more so than perhaps before the pandemic?
I think if you look at some prices, then they're elevated relative to historical levels. You know, there were times before the pandemic when you had, it happens periodically. Equity prices will move up and down, and we do monitor that, but we're not targeting any level of prices for particular financial assets. We don't have a view that we know what the right price of any particular financial asset is. We do look at overall financial conditions, and we ask ourselves whether our policies are affecting financial conditions in a way that is what we're trying to achieve. But you're right, it by many measures, for example, equity prices are fairly highly valued.
Let's segue to the topic of AI and largely AI stocks and periphery stocks really driving the markets in many ways. Let's talk a little bit about the great unknown of AI. And if we think about various ages, our industrial ages, whether it be steam to electricity to the information age and now to the age of AI, would you consider this to be the most disruptive force ever in modern American history?
I think it's way too early to say that. I wouldn't go that far. I would say clearly generative AI has all the earmarks of an emerging technology that could be very important in our economy and in our society. But it's very early to be making that kind of bold statement. So, what we're seeing is companies and institutions like the Fed for that matter, are starting to experiment with how this new set of tools can be used in our operations. Mm-hmm. And it's very early days on that. And, I think we have to wait and see. That's a good thing. I know many of the large financial institutions and other central banks, and we are asking ourselves, how can this help us do our jobs better? And I think it's going to be a period of experimentation over a period of years. And, the history is always that there's a lot of fear that technological innovation will eliminate jobs. What has tended to happen in history over time is that it just raises productivity and creates new jobs to replace the old jobs. And that happens. And sometimes it can take a long time, but ultimately that has been the pattern for the last couple of 100 years. Is this time going to be different? I just don't think we know yet. I don't think anybody knows.
Mm-hmm. You are a labor market futurist, also a historian, and the concept of AI and humans in the loop, very profound impact on the labor force. What are your thoughts about specifically agentic AI as a differentiator from generative AI, and how will the Fed be looking at the impacts of the workforce, the labor participation rate, given the unknown of what could happen with displacement around AI tools at all ends of the spectrum?
Our tools work on demand, basically. Lower interest rates, higher interest rates, they work on demand. When there are structural changes in the economy, there's not a lot that an interest rate change can do for that. And so if you're talking about distributional issues or labor force participation or retraining or any of the things that come to mind in connection with those questions, that's really going to be something for legislators and the private sector. We of course, we have many labor economists, and a good portion of them are studying what the potential effects of AI on the labor force. And many great economists around the country and around the world are publishing on that now. And it really is too early to say. I think you can say that some jobs are going to be phased out, some jobs are going to evolve, and people are going to be further trained and that sort of thing, and be able to keep a job like that. And there'll be new jobs that come. And how will that balance work out, and what will be the timing of it? I think it's just quite hard to say.
But how does that factor into the deliberations? On a near-term basis, things are moving so quickly, and the observation and the argument that artificial intelligence isn't just impacting those entry-level jobs and those, quasi-unskilled jobs, but really tentacles reaching into highly skilled professions, whether it be finance, whether it be communications and media, whether it be healthcare, whether it be law, finance. So all ends of the spectrum, highly educated individuals down to more automated, more easily automated tasks. Sort of a really interesting problem for those of you that are studying labor market economics. How do you approach that?
Well, a lot of what we're doing with our time is trying to understand the current position of the economy, what's actually going on in the economy today. Pardon me. So part of that is hiring rate has really dropped. Job creation has dropped very sharply. So what are the factors there? So I mentioned earlier, I think, part of it just is there's a lot of uncertainty about the direction of public policy, and so companies are holding off. They're not hiring, and when you don't hire through attrition, your labor force shrinks, and you save money that way. That may be a way of passing on tariff costs. It may be something like that. So that's happening. Lots of questions around whether AI is a major factor associated with the relatively low hiring rate for people just graduating from school and just entering the labor market. And people are doing studies on that, and I looked at one from Stanford, another from the New York Fed in the last week, and the sense of it was, we think we can find some evidence that generative AI is having some, it's one of the reasons here, but we can't really say it's the main reason. Can't really say it's the main reason. And we have our Jackson Hole conference every year in Jackson Hole, Wyoming, and we had some great labor economists, and one of the big debates was what's going on with AI, and there was a professor from, I want to say, Columbia, who just basically said there's no evidence that this is acting any differently than her view was not acting any differently from other technological movements, waves, and so I think she would be more at the end of an optimist, a techno-optimist. Mm-hmm. We've all, there are books out there that will tell you the world is ending, and but I don't think we know. Again, I think we're going to see how this evolves, and again, if it does turn out to be something where labor force participation really declines in a way that creates social difficulties, that's going to be something that legislators and the private sector will have to address. We just don't know that yet, though.
Over the weekend, I read where you had been discussing, just picking up on what you said about Gen Z and college graduates and any possible disruptions in trying to find jobs. So Gen Z would be those born between 1997 and 2012, roughly ages 13 to 28. What are your thoughts on college enrollment? We'll talk a little bit about labor disruption in just a minute, and Jackson Hole, because I know that's a favorite of yours, but a lot of the individuals in this room today may have family members that fall squarely in that 13 to 28 category. What would you say about that?
I mean, again, we all see the data that it's just gotten tough for people just entering the labor force to be hired. But remember, the overall national aggregate hiring rate is at very, very low level. The layoff rate is also at a very, very low level. You're in a low fire, low hire economy. And it feels like companies are they've kind of stopped hiring or slowed down their hiring because they want to see how this all shakes out. We're having very important changes to economic policy in the United States, and companies and people are wondering, how's that going to work out? So I think that's part of it. The other thing I would add, though, is there's a lot of good scholarship around technological innovation and inequality, if you will. And the sense of it is really that if schools and society give students graduating the skills and aptitudes they need to benefit from evolving technology, you can have declining inequality over time. And that's what the United States had for many, many years, up until about 1970, when U.S. educational attainment kind of plateaued and inequality takes off. So it's really down to having the skills. So kids who come out of school today with technological skills and can work with this new technology, they're probably going to be fine. They're going to be great. If you don't have those skills, though, you're increasingly left with less attractive employment options. So in a way, it's an educational issue.
Our society is our education system, and you spoke about inequality, particularly the digital divide, and thinking about where the United States really has paced among countries throughout the world. Particularly, that was a subject that you initiated at Jackson Hole back in August. What are your thoughts on how that is likely to really change the way we look at technology as a force for productivity and advancement?
I mean, technology has been raising incomes and productivity for really a couple hundred years since the Industrial Revolution. It's been an amazing thing for the quality of human life, and there's no reason why that has to change. In the United States was the first country to have gender-blind secondary education, and if you go back, you'll see that there's a great book on this, but it just basically the U.S. had fast technological innovation for a century, and also declining inequality because people were coming out and their educational the capabilities they took out of the educational system gave them the ability to benefit from evolving technology. So, and that's really the key, because technology, what it does is it makes us more productive. One summer I worked on a project that was building houses, and I basically had a shovel and I just dug most of the summer. And now that would be a Bobcat, which can do 100 times the work, no blisters, no water breaks. It's just much more productive. And you see housing production's gotten, at least it did get for a while, much more productive, not so much lately. But that I think is the story. And while U.S. educational attainment, college graduation rates and things like that leveled out, they're still going up. The rest of the world caught on and has really caught up in terms of educational attainment. And that really is the key. To your point, your educational system, your country is your educational system ultimately. It's the people that come out and what can they do, and a variety of other factors too, obviously. But I think that's a key element. I'm struck by this because this was a major factor at our recent conference, and we had a great conversation about it.
Well, tell us about the book. You gave me a homework assignment the other day, so I did download it, but I think everyone should follow that lead.
All right. It's a book called The Race Between Education and Technology. It's by Claudia Golden and Larry Katz, two Harvard economists, and it basically talks about the race between education and technology. So I recommend that to anybody. It was written in, I want to say, 2005, and they basically presented at Jackson Hole, they presented an update to the current day. The findings basically hold. It's very, I mean, I'm not a PhD economist. I read it 20 years ago.
But you said it still holds very much true today.
It does. And I think it's a good explanation for why the U.S. has had, rising inequality. This is their thesis, and I think it's they call it also skill-biased technical change. So you need skills to benefit, but if you have those skills, then technology makes you more productive, and that's what we need. Incomes can only rise if productivity is increasing. We're sort of working as many hours as we can work now, so it really is down to how much output can you have in an hour, and that's productivity. So I would recommend that. I'm not getting any royalties for that, but by the way, Claudia Golden won the Nobel Prize for her work about 2 years ago, so I'm not the only one who thinks it was good work.
Chair Powell, let's move on to tariffs. This is an issue that confronts the business people here with us today. You addressed it very briefly in your opening remarks. You indicated that you believe that the costs of the tariff movement is in fact more transitory than embedded in supply chain. So I think we would appreciate hearing more about how the Fed thinks about evolving tariff policy.
So we're now collecting a good bit of revenue. The federal government collecting a good chunk of revenue, $300 or $400 billion a year pace. And the question is, who's paying that? And the candidates for paying those tariffs would be the exporter, the foreign exporter, or someone on our shores. It could be a company or a retailer, or someone who's using the imported product to manufacture something, or the end consumer. And so so far, in its incredibly early days, it doesn't look like the overseas exporters are carrying the bulk of it. It looks like it's that middle group. It's retailers and it's importers, and they're not passing along to consumers that much of the cost. So the actual effects on inflation have been quite modest so far. It's really not. It's a small amount, but I mean, for example, I mentioned that core PCE inflation is 2.9%. Maybe 0.3 or 0.4 of that is tariffs. So it's not the big factor. It's not a big inflationary thing, but it is something that is driving up inflation a bit. And the question is, are companies then, are they going to eventually be able to pass that stuff through? And then that might drive inflation up a little higher. So we've been watching this since the beginning. It's half our mandate is inflation. And I would say that the pass-through to consumers has been later and less than we expected. How much of that will continue, I don't know. But the responsible thing from our standpoint was to watch and wait because it's our job to make sure we don't make a mistake on inflation.
Well, that was my question. Do you imagine that is going to change, where the cost of tariffs will be more deeply embedded and passed on to the consumer? What do you foresee as?
So our forecast, and I think almost all the forecasts are for there to be a one-time pass-through, which will go through the end of this year, well into next year, and that by the end of next year, the one-time increase from the tariffs will be done, and you'll be back to the non-tariff related inflation, which should be much closer to our 2% goal. That's almost everyone's base case. It's actually our job to make sure that that's the outcome, though. So we can't be in a situation where we're just going to assume that. We can't leave that part of the goal unguarded. And so that's why we've been careful about cutting. We didn't want to cut too early. I mentioned in my remarks, if we cut too early, we may find out in a year that inflation actually wasn't under control and it's back up to 3.5% or 4%. No one thinks this is the base case, but that's the risk of cutting too early or too much. Of course, the risk of cutting too late, as I mentioned, is that we unnecessarily, the labor market weakens unnecessarily. There's no risk-free path, and it's a very difficult policy environment when your two goals are telling you two different things. You've got to make a compromise, and we really, again, haven't been in that situation for many, many years. It does happen, but it's happened now, and we'll manage our way through it. But we sort of have to look at both of them as equal. We can't just say we're going to do this one and not that one, unless this one is clearly a greater risk. And now they're coming into closer balance, I would say. We do see meaningful weakness in the labor market now, very low job creation. The unemployment rate's still low, though, and the quits rate is low, and a lot of things suggest that the labor market has reached a kind of unusual stability of much lower demand and much lower supply for workers. It's a really unusual kind of a balance, if you want to call it that, but nonetheless, we think it's downside risk.
Well, if you could elaborate, what are some of the factors that are leading to depressed demand for labor?
So depressed demand for labor, based on surveys and talking to people who are doing hiring, a big chunk of it is that they're just unsure about what to do. Businesses, and I'd love to talk to people after this. Businesses don't want to do a lot of hiring. They may be postponing major capex, major initiatives, major acquisitions, and maybe they'll replace workers who retire, but they're not looking to grow. This isn't every company and every part of every company in the world. It's just an effect kind of at the margin. That's got to be part of it. I think that's the demand side. The supply side, of course, has a lot to do with immigration policy. So immigration was at a very high level for 2 or 3 years before this year, and now immigration has really gone close to zero, and immigration is not really contributing to the labor force growth now, whereas it's been most of what the labor force growth was, and now so at the same time you've got declining demand and also declining supply of workers, of new workers.
One of your passions is demystifying the Fed. You enjoy speaking about it, and those that are Fed watchers are wondering, will there in fact be 2 additional rate cuts before the end of the year. Of course, we're uncertain about that, if I understood your comments correctly. What does it mean to demystify the Fed, and what can each of us in this room do to be better Fed watchers for the benefit of our own businesses, if you will?
So not so many years ago, maybe 40 years ago, and for a long time before that, the main theory of central banking was to be mysterious and obscure. In fact, Montague Norman, who's a very famous former head of the Bank of England, but ending in the middle of World War II, famously said, never apologize, never explain. And he thought that monetary policy worked back, and everyone thought, it works best when no one understands. It's kind of mysterious. So starting maybe 40 years ago, a bunch of economists, including Alan Blinder and a number of others, said, you know what, that's wrong, because if markets and the public understand the way you'll react to incoming data, then they'll kind of do your job for you. And so they argued for greater transparency. And people said, you know what, that makes sense. So central banks started being transparent. The Fed didn't even issue a post-Federal Open Market Committee announcement until 1994, and then did so as an experiment just to see what would happen. Now, so if you fast forward through, the 30 years since then, now we have a post-meeting statement, we have minutes, we have press conferences, every FOMC participant is on Squawk Box, we have a press release. So, and maybe some people say it's too much, it's excessive, but so that's the way it's evolved. So we try really hard to communicate with the interested public in a way that is useful and comprehensible and jargon-free. That's what we focus on. And that's all we're trying to do. So we don't use their, every profession has their jargon, and you kind of need it for internal conversations, but we try not to do that. So that's all we're trying to do. A couple of thoughts about what, I wouldn't say, I can't make anyone a better Fed watcher, I don't think, but things I would want to tell people about the Fed. One is just this, that we're making decisions, our decisions are made under elevated levels of uncertainty, even in normal times. The economy is fundamentally, no one has been able to predict the economy more than for the next few months. It's an unpredictable, it's this enormous entity, and it's just not that predictable. So we have to we take very much a risk management approach, and one of the risks we're managing is that we don't exactly understand what the current state of the economy is and where it's going to go. Range of plausible outcomes, not just one outcome. So that's one thing. So we're never saying that we know the economy is going to do this or we know it's going to do that, because honestly, it just, famous statement is, financial forecasters are a humble lot with much to be humble about. So that's one thing I would say. Another is that you should, I just have to say this, whenever we make decisions, we're never, ever thinking about political things. And so we're based in Washington, D.C., and many of people, in Congress, and often things are seen through a lens of, is it good for this party or bad for this party or this politician? We're just not looking at things that way. We're looking at what's the best thing for the people that we serve in the medium term. What's the best policy? And many people don't believe us because they think, come on, you're really political. But the truth is, most of the people who are calling us political, it's just a cheap shot. And also, we don't engage. We don't, our argument is doing our jobs. We don't get into back and forth with external people. We just do our jobs. We keep our head down and do our jobs. That's what we do. So those are two things I would offer about the Fed.
We have run out of time. We have come to the end of our program, and I'm wondering if there's anything additional that you'd like to share with the members here today, and again to help us be more prepared as we begin to look to 2026 and strategic plans for business and things on the horizon that would help to, of course, create more jobs and more prosperity.
So I'll say one more thing that struck me just now about the Fed, and that is, remember, we have a really important job. Maximum employment, price stability. We regulate and supervise the banks. We operate parts of the payment system. But those things are really about cyclical demand management and financial stability. The policies that really matter for the U.S. economy in the long run, things like investment, particularly investment in people, that's not something we can do. I think we get a disproportionate amount of attention compared to the things that really matter for the country, which are the things that Congress can do and the private sector can do, which are the things that will really matter for future generations, are not interest rate policy and the things that we do as important as we are. And beyond that, I'll just say this has been great, as always. I've enjoyed talking to so many people here today. And, I love to get out and talk to people who are working in the real world in the economy. There's nothing better than that. Most of my career was in the financial sector, and I constantly was out talking to people rather than sitting in my office looking at aggregate data on the economy. So this is a much more comfortable place to be.
You are headed back to D.C. later this afternoon.
Yes.
What does the rest of your day look like?
Get home. I won't get home until after dinner, so it looks like me working on the plane on the way back. So anyway, thank you so much. It's been great.
Thank you.
Thank you.
Chair Jerome Powell, Chair of the Federal Reserve.